Hello, and this is Module 3 on FX, the last and final module on FX, and we're looking at Topic 5. Here we're looking at factors that influence the FX market. We're going to have a very broad and general brief discussion over these factors, but I do encourage you to download the manual and go through it. It's got far more detailed information and further explanations. But let's just touch on a few factors that would affect the FX market. So when you look at factors that influence the market, it tends to help when you use a filter approach or a funnel approach where you start from the big topics and you filter it down to the smaller, narrower topics. So if you look at the bigger type of topics, then you'd look at the global risk environment, the country's economy, the balance of payments. So basically, balance of payments, that basically looks at a country's trading position with the rest of the world. So is the country net importing or net exporting? So in the case of South Africa, for example, we're a net importer, right? So that means if we're net importing, we're importing more than we export. So to import goods means that we need to sell our rands to buy foreign currency, okay? And that would have a weakening effect on our currency. And then you'd look at things like the flow of information, market perception, market followers. So there's information all around online. There's lots of access to information of what's happening in financial markets. And also the news also informs perceptions about a country. So for instance, South Africa as an emerging market country, when things go wrong in emerging markets in general, it would basically tend to dampen emerging market sentiment. And sometimes investors or market participants would group South Africa up with the rest of the emerging markets, and when emerging market sentiment is low, then you'll see people pulling out investments out of emerging markets, which could also possibly affect South Africa, and that would have an impact on our currency, because then it means that people would then be selling the rands back into our market, and that would cause currency movements. And then you've got market followers, who are people who follow trends. So they believe that all the information, trading information, is contained in the current price. The current price tells you everything you need to know about a particular security that you're looking at that particular time. So those type of people would look at technical analysis instead of fundamental analysis, looking at trends, looking at charts, and different patterns in the trends and the charts, and they would buy and sell based on signals that they get from their analysis, the technical analysis, and that would impact and influence where the rand trades on a particular date. And then also things like proxy hedging. So for instance, if you take the case of Botswana, South Africa, okay, both in Southern Africa, close together, there's no real big market for the Botswana trading against Botswana pula trading against the US dollar, whereas there's a more established market for dollar rand. So what offshore investors would typically do is, if they wanted to take a position or hedge, they would do a proxy hedge. So they would see the dollar rand as a proxy for the dollar Botswana pula, and then they would then trade the dollar rand as a proxy hedge for Botswana pula. So even though they would be looking at the Botswana pula market, they would then proxy hedge using dollar rand. So that would actually affect what happens to the rand and rand levels. And then it's also things like supply and demand. So in the previous modules on FX, we spoke about how the FX market is a huge market with over 5 trillion transactions that happen on a daily basis. But we know that it's not just the buying and selling of goods that are the only transactions in the FX market. You also get lots of speculators, people taking views on the market, and that affects the supply and demand dynamics within the market. And then also things like event risk. So, you know, the risk of things happening in a country, strikes. In South Africa, we had, you know, negative sentiment over the mining strikes, the protracted mining strikes. So all those type of events also have an impact on sentiment towards the country, towards the currency, and also affect where the currency would trade. So that is all we have on this particular topic. As I've said, there's more on the manual that you can download online. So when you do have a moment, do try and download that for more information. Thank you.